everyone. Thank you for joining us for today's webinar, Benchmarking Return on Technology Investments, presented by Aite Group Managing Partner, Sang Lee, and Alphacution Research Conservatory Research Director, Paul Rowady. I'm Lori Spenley, and I'll be one of your Aite Group hosts for today's webinar. It's now my pleasure to introduce today's speakers. Our first presenter, Sang Lee, is co-founder and serves as Managing Partner of Aite Group. Mr. Lee's experience lies in the securities and investments vertical, and he has advised many global financial institutions, software and hardware vendors, and professional services firms in sell-side and buy-side electronic trading technology, market structure, and retail brokerage technology evolution. Joining Sang is Paul Rowady. He is the founder and director of research for Alphacution Research Conservatory, a company originally established in 2004 to develop high-end, visually intensive trading and research systems. Please welcome both of our presenters, and without further ado, I'll turn the mic over now to Sang. Thank you for joining us today, and enjoy today's webinar.
Thank you, Lori. Very happy to be here along with our very good friend Paul to participate in this webinar really around the exciting topic of benchmarking returns on technology investments. So during the last quarter of 2016, with the help from our great partner Alphacution, Aite Group and Alphacution together published a report entitled Return on Technology and T. Greek's Framework in the beginning. So really the main goal of that particular report was to try to introduce this concept of return on technology and provide some of the definitions around T. Greek's to really kickstart a conversation around how firms can better manage their digital transformation and hopefully, ultimately learn how to optimize their overall IT investments. I think we should certainly view this webinar as really a continuation of that particular discussion that we started in October of last year, because not surprisingly, we got a whole lot of questions from our clients related to those concepts, and also a lot of questions really about what's next to come. So to address some of those questions and perhaps some concerns, Paul and I have decided to co-host this webinar, and we hope that over the next 45 minutes or so, we can have a really constructive dialogue and hopefully hit some of the questions that all of you may have. So with that in mind, we'll take a quick peek at our agenda. So when you, actually Paul, can you go back to the, yep, right there. So I'm going to sort of quickly tackle the first two items, namely going over the market reality and introduction of Alphacution, and then I'm going to actually turn it over to Paul. And he's going to do a really deep dive into the concept of measuring return on technology. And then I'll rejoin Paul at the conclusion, make hopefully a few clever remarks, and then we'll leave some time at the end, plenty of time I hope, to tackle any additional questions that the audience may have. And I can't remember if Lori mentioned this, but we've also put together a few polling questions, and we'll go through those during the discussion, just to make sure that all of you are obviously paying attention and not falling asleep. So with that, we'll start. I see that Paul has moved on to the first chart. And looking at this slide, and obviously, we spent a lot of time, and when I say we, I mean mainly Paul, but really trying to figure out what the first chart should be that would literally punch the audience in the face in describing today's market reality. And this is essentially what Paul came up with. So when you look at the slide, it shows the change in total headcount of top 9 investment banks over a period of 41 quarters, starting at the end of 2006. And I think there's two very interesting sort of takeaway points. Point number one, I think it's somewhat of a side note, but still very interesting. At least I thought it was very interesting, actually, when I first saw this slide, was the eventual decline of headcount within these large investment banks really didn't happen until Q3 of 2011. Certainly, when you look at the slide, immediately following the crisis emerging, you certainly saw it, but a sort of a mini recovery leading up to Q3 of 2011. And after it peaked there, and then once the decline started to resume, it really took a nosedive, ending 2016 headcount more or less on par with the 2006 figures, which leads us to point number 2, and really the key takeaway of the slide, is that the market reality is forcing firms to do more with a lot less resources to remain competitive. Next slide, please. So even though many years have certainly gone by since the global financial crisis appeared, we certainly still feel its impact both on the shrinking opportunities and tight budget side, as well as increased regulatory burden and pressures. So under this market reality, some may say harsh market reality, transformation and innovation have been extremely difficult to put together, to say the least, and when forced to do more with less, I think there's a growing recognition that IT strategy is becoming a very important part of overall business strategies as firms move gradually towards recovery and, in the long run, towards growth. Next slide, please. And this leads us to a very brief introduction of Alphacution and why Aite Group, us, have decided to put together a partnership. As Lori mentioned before, I think probably in a much better way, Alphacution is basically a data and analytics firm that's developed a standardized data-driven framework that could help you measure technology leverage, also known as return on technology, and perhaps more importantly, enable firms to calculate their tech dividend or tech debt. So by putting together this partnership with Alphacution in October of 2016, together we hope to provide our clients with unique insight into how to better leverage and manage their overall technology investments. So before I turn it over to Paul to dive into the meat of the discussion, wanted to throw out our first polling question, number 1, and I'll sort of read it right now so you guys could do a quick vote. Does your firm measure effectiveness of your IT investments? Yes, no, or don't know? And we'll wait a few seconds as the audience votes. Paul, what do you think the overwhelming answer will be? Any thoughts?
Yeah, a ton of thoughts. Just thanks for the wonderful and kind introduction. We're pretty excited about the exposure and also the guidance that your team gives us for building out what I certainly think is a fascinating roadmap. My guess is that for the largest of institutions that are highly fragmented, the answer is going to be different. My expectation is that the predominant answer will be no. There'll be an occasional yes, and it'll be interesting to dig into that, below the surface to see what kinds of businesses, what segments of the ecosystem would be answering yes. My guess is that it would be the more technically intensive segments where it's going to be much more important to have a bead on what you're spending, what you're receiving from that spend. Just as an aside, I don't know who's going to confess that they don't know, but the reality is, I think that a lot of folks may not know if they're actually measuring this return on investment concept, return on technology investment concept.
Okay, so we have the responses here. Surprisingly, a lot of yeses relative to no and don't know, but obviously no and don't know combined, not surprisingly, I think, make up the majority. Great. Paul, do you want to, I guess, begin your section?
Yeah, let's launch into level setting here, and let me walk through some of the framework before we get into the case study. So I thought this was a good place to start. What is it? I found in interacting with clients and prospective clients in the broader network is developing some new language here, and I think that's going to take a lot of support, a number of tutorials. A webinar like this certainly is symbolic of that, some evangelizing. But putting it simply stated, in an organization you have essentially two primary engines of productivity. You have a human capital engine and you have a technology toolbox engine. And how those two engines interact is really what's going to produce your performance, which we're equating performance in this case with total net revenue. Whether that's of an enterprise or a division of the enterprise, we'll get into some of the specifics as we move down the page. But in the course of doing this modeling, the first major epiphany that we had was comparing the cost of that performance to the performance itself, and that was the genesis of this T-Greeks framework and the initial analytic that we call T-spread. I use terms like technical leverage, technology leverage, and it's really fascinating to look at what the technology leverage is when you look at different kinds of businesses in the financial services sector, and then the nuances between like-minded competitors or peers. And this ultimately got to the benchmarking aspect. I'll show you a little bit as we get through the slides, but what really helped us normalize for scale, since so many of these, and the case study is about global banks, are so different in scale. You have mega banks with 200,000, 300,000, 400,000 employees, and then you have more regional or more business-focused banks that 30, 40, 50,000 employees, and all up and down the spectrum. And the question I had was, how are we going to compare those? And the answer we arrived at was by normalizing by their head count. And that really turned an apples to oranges comparison into more of an apples to apples comparison. This final bullet point about being fractal, and I know that's a bit of an obtuse mathematical term, but it's one that's actually come up a few times, and one that foreshadows where we're heading on this so-called research roadmap, that right now we've focused on enterprise-level return on technology, which specifically is really net enterprise return on technology. As we focus on specific business segments or more homogeneous businesses that are not highly diversified, we get further and further into the granularity of the benchmarking, which takes us from enterprise to specific business segment to ultimately specific workflow and solution-specific benchmarking and comparisons, assuming the availability of inputs. And right now, again, this foreshadows some of the next slides, but we have been focusing on enterprise-level analysis because I want to tie the numbers to some reality and understand what the value of the pie is. So the next question here is, how is this going to help you? This is really the bottom line. And this opening piece, I think, is relevant to the entire audience, all financial services industry participants. I think while a number of the folks that we talk to are eager to be able to benchmark and compare specific spending patterns and technical leverage like analytics, return on technologies for specific applications, whether it be risk or trading systems or surveillance, for instance, and we will get there. I think that there is a value proposition today which is around the framework and beginning to think and speak in terms of a framework. So whether you're digesting our output or, according to the first polling question, there seems to be perhaps more analysis internally amongst companies of their technology investments, that they begin to think on their own in terms of some kind of standardization. Maybe it's in order to compare the return on technology investments across teams, across regions, across solutions, across business segments. There's a number of ways where having a standardized mindset, at least, is going to pay considerable dividends. Otherwise, you're just comparing the spend rather than the impact of the spend. The other term that I have come across that I think makes a lot of sense is this idea of navigational intelligence. Transformation has and will continue to be a primary theme in the ecosystem. And by my estimation, we have a lot of lip service being paid to the components of that transformation and how to go about that transformation. But given my own background in designing and developing and implementing trading systems, particularly highly automated trading systems, I bring that mindset to this exercise, the idea, which is ubiquitous, you can't manage what you don't measure. And I think measuring what these impacts are provides a ton of very impactful intelligence, navigational intelligence for how you're actually going to execute on your transformation. Now, these next set of bullet points, we've bifurcated the ecosystem into the buyers of technology and the sellers of technology, the solution providers, and I think that there is both broad and deep implications for having this data-driven input around technology investments that provides local intelligence, intelligence over time, how a particular company or the competitive landscape is shifting, and certainly the competitive intelligence comparing spending patterns amongst peers, competitors, components of the ecosystem. I also think that on the solution seller side, there's something called, that I'm calling sales intelligence, understanding your clients better. And certainly there's the marketing and the product design strategy implications from having this data-driven output at your disposal. So where are we today? Well, we have been incredibly busy modeling different pieces of the ecosystem. I'll show you some upcoming studies that we have that are going to expand that fairly dramatically. I think the one that we're going to use here, the one that's most comprehensive, is the enterprise level analysis of 58 of the largest global banks in the world. And this picture here really encapsulates the entire framework in each of those 58 companies. We've developed individual models about those individual companies and then turn that into a composite model of the sector. And so this is really a picture here in the middle of the slide of where all those banks where all those banks reside in relation to what we call T-beta, which is kind of the market spend per employee, the market. This is the weighted average T-spread. We're going to get into the definitions. I know we haven't done all that yet, but you can see that here the bulk of, and it turns out it's 52 of the sample, are within plus or minus 1 standard deviation of this weighted average, and that there really are only a handful, 6 in this case, of the banks that we modeled that are exhibiting some quite notable deviation from that group. So finishing up the slide, as I mentioned, we're modeling individual companies. We're modeling them in several what I call profiles that represent the ecosystem. Our output comes from those individual models and then the composite models of the profiles. So the IT services profile, which is our next upcoming study, enterprise IT, big fintech, as opposed to smaller fintech and others. And then what we've done is while we do generate reports, as Sang alluded to earlier, what you find within the site is our two exhibit libraries. They're essentially chart libraries that show the pictures of the output. The open library is accessible via a free registration, and then the premium library is where we have our subscription service. Looking a little bit at the roadmap, we have a very ambitious and busy plan for the year ahead. This slide just represents what we're looking to accomplish this year. The vision goes quite a bit beyond that, which is ultimately to develop and assemble a 360-degree composite model of the financial services ecosystem so that we can kind of look at the ecosystem from all these various perspectives and use that context to define themes and narratives of what's really happening based on the data and the modeling. Our next study coming out hopefully in the next month or so is based on modeling of actually a little bit more than 23 providers of the largest providers in IT services. We have a buy-side study coming out. We're going to look at the exchanges and also do an update of the global banks while simultaneously expanding some of the analytics that we look at for global banks, as well as expanding the number of banks that are in that composite model. Ultimately, by the time we get to the end of the year, we will have essentially a doubling of the individual models, and the composite models will have 4, 5, 6 composite models, which, by the way, is going to start to become really fascinating as we look at the intersection of the composite models and see what different profiles say about the other profiles. So that may generate some questions. Hopefully it will, both at the end of this webinar and ongoing. So here we land. I don't know, Sang, if you want to take this, but our second polling question: what kind of benchmark do you use to measure return on IT investments? Saying it while we're looking for the waiting for the input of that. Any thoughts or reactions to what I've said so far?
No, I think it's a good description of. I mean, that's essentially what we were hoping to get to, right? What it is, how it's going to help our clients, and where are we headed with this. And I think the next slides to come, just in terms of how the data is built, right, in terms of building out into the various T Creeks, I think will hopefully give a lot of details that everyone is looking for. And really, I think the ultimate goal of this is to get more questions, get more guidance. So it'll be very interesting to see. I think this is actually a very interesting poll question. Assuming, I guess, people who are trying to measure return on investment, what sort of benchmark, if any, are being used. So, okay, so internally developed wins out with 38%.
Yeah.
Third-party developed, whether customized or standardized, at 5% each. 30% don't benchmark, and 22% don't know. So,
yeah, that's fascinating.
Yeah, I'm actually surprised by the internally developed part, although you've looked at this a lot longer than I have.
Yeah, that doesn't really surprise me. My guess is that the inclination is initially to start measuring on your own and looking internally at what you have and how you're going to operate on your own. That makes sense. And I think that we're actually fairly early on in this whole conversation, so that the fact that using a third party to try and develop some kind of benchmark, I think, is indicative of the fact that we're heading in that direction, but we're early on, which I think from our perspective is probably a blessing and a curse. I think that this, there's a lot of growth yet to come. The curse is that there's a lot of education, evangelization, et cetera, that needs to happen, and for folks to understand that there are third parties out here that can help.
Okay. All right.
So I'm going to pick up the pace here and get into the case study. Very quickly, I mean, this whole thing started about 3 years ago in a prior chapter when I was asked by a client to put some data around a TCO assignment. There was a lot of messaging around, you know, total cost of ownership, and our managed services solution is going to save you a boatload of money. And the question was, well, how much? Can we start to actually measure? And so that got to this early question is, well, what do these firms spend on technology? And that really was the start of this whole thing. And I wasn't sure that I would find numbers, and then I realized that there may be some numbers you know, out there in the public domain. I figured that the global banks were going to be amongst the largest buyers of technology, so that seemed like the best place to start, if not the largest buyers of technology, when you have, you know, firms like JP Morgan having a tech budget, you know, somewhere around $9 billion for 2016. So that seemed like a good place to start. And given some of my experience also in a prior chapter of digging through 10Ks and 10Qs and other filings, annual reports, I actually found quite a bit of data that was relevant to answering the question. The bonus prize here, though, is that when you go through this process, there are more insights and more clues and more fascinating narratives that come out of trying to answer the first question. So I think I really want to make the point here that this roadmap is not entirely about the benchmarking. The benchmarking, I think, is one of the ranking value propositions. But we're learning so much more about what's happening with the headcount, as you saw before, how these banks are competing, what the impact of regulations. I mean, it's really a long, long list of insights on top of the benchmarking exercise. So there's 6 slides here. I want to go through them very, very quickly. Much of this you can see on our site. I really just wanted to provide examples of the kinds of pictures you can see and the stories that these pictures tell. I mean, in this case, you know, we looked at the balance sheet of a large European bank, and one of the, you know, great insights early on was how the investments in software were changing and growing relative to the investments in hardware, which, you know, again, is a whole other series of webinars right then and there. Sometimes we found the breakdown in capital expenditures and how, you know, we see in this case some changes over the course of 6 or 7 years, in this case 2007 to 2015, where we found some detail on the shifts in the allocation between hardware and software relative to a few other categories. I thought that was incredibly fascinating. Clearly, I think that while we're looking very, very intently on return on technology and technology spending patterns, the fact that we're normalizing our benchmarking exercise by headcount really gets to the fact that what we're doing here is really about the people. How many people does it take to screw in the light bulb kind of thing? And so by looking closely at the trajectory and change and the news about headcount, I think, is also incredibly fascinating. And in this case, I think there's some opportunity for some predictive analytics in the very near future as to where these folks are going and what that means about revenue, what that means about budgets. There are just tons of clues in these pictures. Here's another one where, we grade all of our models. There's no real standards on transparency in these filings. So some of the models are much, much more transparent and much more illuminating than others that are quite opaque. So we use strong models to help us figure out what's going on in the weaker models. This happens to be an example of a stronger model where we can actually see an index how the front office headcount is changing in the business divisions of this particular large European bank. And coming from saying where you and I sit and looking often very closely at global markets, capital markets, trading-oriented businesses, the fact that you have this global markets index falling off over the course of these, 7 quarters ending mid last year, really fascinating stuff. Revenue per employee, as you'll find, is one of my favorite analytics for reasons that we're probably not going to have time to get into, but this is like the signature of a business. There's an inherent revenue per employee, which is another way to think of the amount of automation and the amount of technical leverage that is inherent in various businesses. Some businesses are not very automated, namely, your retail side of the spectrum, whereas on the wholesale side of the spectrum, you have some incredible technical leverage. You also have a lot more volatility. So again, there's a lot to talk about, a picture worth 1,000 words. I'd say at least that in, a chart such as this one, and we have many of these. And finally, what came out of our inaugural global bank study last year was breaking down the core components of the spend for these 58 global banks, our sample, and then what that says about what we think the whole global bank, enterprise, TCO, what that whole spend looks like. And it looks like, from 2014 to 2015, not only are these numbers big, but they're in decline and they're shifting. And we've predicted that software is actually going to become the biggest piece of the spend. As you have hardware compression and you also have skills mix shifts and downward pressure on the IT human capital component. Again, these are another series of webinars. We could talk around just some of these specific slides. So here we land at our third and final polling question. How important is making strategic IT investments for your firm's future growth? And saying while our audience is responding to that question, I'll ask you again if you have any reactions to kind of the setup.
No, I think it was pretty important to highlight some of the key insights that you're able to provide today. And I would imagine a lot of the questions post-webinar is going to be, right, what's to come? And I think that's one of the questions that we actually got a lot of as a result of the report being published. So I know you're going to sort of touch on that as you go through the different definition of key Greeks and so on. So I think that would be pretty important. So let's see how, I would imagine it's going to be overwhelmingly very important. Yep, so the results are in. 0% for not important. Very important is a clear winner at 65%. And important is 29%. So it's not surprisingly majority.
So maybe we're on to something.
Yep. So
maybe we're on to something.
Yep, absolutely. You should.
So so this, I mean, we've kind of alluded to this slide, key discovery number 1. I think really when I figured out that I could normalize for scale by using headcount, that was a really key discovery that allows us to get to a framework and really measure this, the impact of the technical engine on top of the human capital engine. And it really sets the stage in large part for what the roadmap looks ahead, which is ultimately to tackle the benchmarking of the key technology buyer side of the ledger. We can get into why that may not be as important for the technology seller side of the ledger, although really this is ubiquitous. We could measure this for both technology buyers and technology sellers. I think that for the ecosystem and understanding the audience, we want to look at the profiles of the buyers first. So that's a primary focus, as well as rounding out this ambitious goal of the 360-degree view, which is to look, up, down, across, top to top to bottom, front to back, and I think we have a slide that kind of illustrates that towards the end. So I want to, again, go through really the bulk of the presentation here, since we've shown some pictures of, you know, specific clues that we found, specific output of modeling. How do we then bring it together? And so we arrive at this slide here, which is really the somewhat of the standard look, which is I've got a series of players that are at least in the same corner of the ecosystem, but then there are differences. You know, there are regional differences, there are business mix differences, there are scale differences, cultural differences, and on and on and on. So, you know, while illuminating to look at a slide like this where we've selected a sample of 5 companies from the broader sample of 58, what do you spend on technology? This answers that question. But then it begs more questions, which you know, we can't really compare in this way. And we may want to try and compare in terms of the percentage of the allocation. But even then, we're not addressing the scale differences. This is incrementally illuminating, but not as far as we could really go. And then, so, you know, the statement here, though illuminating, looking at these allocations did not address the scale differences among the different firms. Well, here's the scale difference. And you can see that, you know, while many of us from a U.S. perspective regard, you know, mega U.S. means a bank, and there are a handful of them that have headcounts north of 200,000 employees. You know, China, for instance, is, you know, almost a double of that, which suggests, I mean, it has amazing clues in there for the level of their automation and their buying of technology versus other mega banks around the world. And then certainly we get into, we've got an investment bank here, a custodian bank, and a dealer, one of the primary dealers. So in this case, it turns out that normalizing for scale by headcount is the critical step towards a standardized TCO, or return on technology related benchmarking framework. So look at how this chart now shifts when we look at technology spending not on an absolute basis, but on a per employee basis. All of a sudden, we see that the dealer firm, and this is one of the 22 some odd primary dealers, is spending nearly $230,000 per employee, and these numbers are based on 2015 data, relative to the custodian bank, the investment bank, etc. This is where, you know, we can see how the picture shifts. Now, it still begs the next question. This perspective begs more questions as well. In the final analysis, it really doesn't matter what your firm spends on technology, and this is, I think, is really the statement that Drew sang in, and when we really started to talk about where we could help one another. What actually matters most is what your firm receives from its investment in technology. So that got us to the point where we needed another side of the bookends. We needed another side of the spread. And the other side of the spread, the performance in this case, and relative to the cost of the performance, is the revenue per employee, which I stated earlier is really one of my favorite things to look at, because it really shows the difference between not only types of banks within that peer group and within that profile, but it's something I use across the board for lots and lots of other companies, because it gives you a sense of what the technical leverage is, at least intuitively, amongst all the different profiles. So then when we compare the two, we turn this into the T-spread analytic, which is the core of the T-Greeks framework. We have a bid, we have an ask. Now we're getting at closer and closer to the apples-to-apples comparison of this return on technology, implications for level of automation, again, in this case, on a net enterprise level, We haven't yet gotten to the fact that some businesses within a highly diversified mega bank or mega institution going to be highly diversified. Some segments will be more automated than others. Some will have more tech dividends. Some will have more tech debt, as we'll get to. But on a net enterprise basis, which is where we want to start, so that as we get further and further into granularity of businesses and workflows and solutions, we can tie back to some reality. The pie is worth X. This profile within the pie is worth that number for that year. And so, ultimately, as we get more granular, everything will continue to add up. We can talk more at length, again, a series of other webinars and videos and reports and blogs around why that's the case and why that needs to be the strategy, even though we're all clamoring to get into more detail and to look into the future. So this is just a quick, now that we've isolated this T-spread, we can look at that relative to the head count in this subset. And again, there are incredible stories in here, the China one in particular. And I'll tell you right now, we've modeled 5 or 6 of the biggest Chinese banks, and they get bigger every day. They all look the same. They have a ton of head count. They throw bodies at problems. And relative to that head count, they really don't spend that much on technology. Now, on an absolute basis, they do because they're massive. But on a per employee basis, they don't stack up to any of their peers. So, the takeaway here, the major clue, return on technology, technical leverage, are correlated to levels of workflow automation. So even though we're not there to measure specific workflows, it's pictures like this that imply at least the portfolio of workflows and what that portfolio of workflows is generating in terms of return on technology, in terms of technical leverage. So now here we isolate the T-spread again just to level set, and here we launch into the benchmarking part. The benchmarking part is when we take our current sample of 58 individual models, 58 individual T-spreads, and in each case over now 11 or 12 years, what I've done with the modeling is I want each individual model to go back before the global financial crisis so that we can see how that impacted the change in everything, really. Change in the numbers, change in the mindset, change in the head count, change in the spending patterns, if any. And so most of these models are going back to fiscal year end 2005. In this case, we're just isolating 2015. We could do this for each year and do a movie and show how this whole thing changes. In the case of 2015, in the broader sample of 58 individual models composited up into the granddaddy model for the banking sector, the T-beta, which is the weighted average of T-spreads, is about $256,000. Okay, so what that means is that the difference between tech spend per employee, TCO per employee, and revenue per employee, weighted average, is $256,000. That's the measure of technical leverage for the sample, and now we can compare that with the individual players. Who's above, who's behind. And that gets it into some of the additional language. We started with T-spread. We calculated a weighted average of T-spreads to arrive at T-beta, which is reminiscent. I mean, anybody out there who's traded options, this is going to be, sort of already sort of intuitive. But even those that, are closer to the front office and understand some of the lingo about the beta of the market, well, this is the beta of this profile in terms of technical leverage. So then that gets to, well, if I'm above that, I have some sort of, I'm in the so-called T-alpha zone. I'm generating, in this case, a net enterprise tech dividend. It doesn't mean that every business in that organization is performing optimally. It just means that the sum of the businesses summarized up to the enterprise level and compared with peers and competitors is in this T-alpha zone. And then, which is anything where the T spread is greater than the T-beta. And then Similarly, again, our option folks out there will understand this as well. If I've got T theta, I've got decay, I've got net enterprise legacy, that's like tech debt relative to the benchmark. So here's really where the benchmarking comes in for this sample, where with these 5 individual banks, you can see who has the most T alpha and who is lagging, again, in this subset. Now we can do this, as we alluded to in one of the opening slides. We'll refer back to what the whole ecosystem, the whole profile, at least our sample of that profile, 58 large global banks, looks like in its entirety. Towards the top of the chart, you have the larger scale. Okay, so as you go up the chart, the enterprises get bigger in terms of headcount. As you move right or left, that's deviation from T beta. So we have about 40% of the sample, which is producing technical leverage, return on technology at a net enterprise level that is less than T beta. That there is, on a net enterprise basis, some level of tech debt relative to your peers and competitors. It also really implies, amongst numerous other things, that there really aren't that many technology leaders in the space. This is the zone that's beyond 1 standard deviation away from T beta. And of course, those who subscribe and engage with Alphacution directly through Aite, etc., are going to see the names behind all this and some of the specific output behind all this. This final one is really just to create an illustration to try and help folks practice. Okay, what is T-spread again? How do you get to T beta? This is like learning a foreign language. You're back in 8th grade. You're sitting in French 1. But this is what it's going to take. We cannot be cavalier about the language and about the definitions. We have to be more accurate, more precise, if the standards are going to hold together, if the standards are going to be applied internally, externally, and across organizations, so that we can begin to speak to one another using this language. Certainly more on that as well as we go forward, because this is what I'm trying to do here, is provide visual output. Not as many words, more pictures, because there's more information, more insight, more impact from the pictures. The challenge is that we don't normally speak in pictures. And so folks who are interested in that are going to have to spend some time understanding what the pictures say, and that's where we have to engage with one another. Sang, I think we're back to you to take us into the home stretch here for the last 10, 15 minutes or so.
Thank you, sir. Incredible, you went through 30 slides.
Yeah, told you I could.
So, I mean, I don't think I'm going to spend a whole lot of time on this particular slide. I mean, I think it's the statements here are fairly self-evident. I mean, I think based on the research that we've done to date, both on the part of Alphacution and obviously on the Aite Group side over the years, and also I think somewhat validated by the small sampling of polling questions that we went through, I think we could all agree that IT strategy is increasingly becoming really an integral part of all of the major market participants' overall business strategy as they continue to try to figure out the next innovation and next revenue generation story. And really understanding how to leverage IT investment is becoming key to capturing future growth. And obviously there's a lot more work to be done on both Alphacution and Aite Group sides, because we really strongly do believe, as I think Paul has mentioned repeatedly throughout his presentation, that really this particular journey has really just begun. So we look forward to working closely together and producing more interesting content and analysis. And I think part of that is understanding really what's to come. And Paul, for that, I think you have just have a pretty decent visual that sort of maps out where you think you're headed.
Yes, I have quite a clear plan for where I want to take this, and I have concluded that this 360-degree idea is really the best way to describe it, and ultimately it means that I've got this, magic 8-ball eventually that I'm constantly updating and maintaining and adding models. I think one of the fascinating aspects that we're going to get to in a subsequent phase as folks understand what we're doing here and move more and more closely to interact with what's been built is that we will move beyond, everything that I have, that we've got right now in terms of the modeling, it comes from the public domain. I think that the value proposition is having the patience, tenacity, and experience to assemble all those grains of sand into a picture that makes sense. I think there are going to be some pretty significant limits in terms of the granularity of insights by just relying on the public data. We certainly are not going to stop there. I think there's just a ton to learn in terms of, if I were building a puzzle, I would typically do the outlines of that puzzle first. And that's sort of what we're doing here, is that we're putting the outlines in place and then gradually building certain pieces of that puzzle inside those edges. We will get to private data. I'm convinced of that. I think that folks will, even already there are a number of companies in the network that have approached us that have said, hey, what if we combine our data set with your data set? And I think that that idea is going to pick up steam. So, ultimately, I want to be able to look top to bottom of the stack. I want to be able to look front to back of the workflow. I want to be able to look across regions. I want to be able to look at different asset classes where that's applicable. Excuse me, certainly in the front office. And that's just the vision that, I feel is that we should be exposing. There's a lot more to it, but I think it maybe highlights some madness to go further than that. There's quite a bit of work to be done just with what we've laid out, and I think it makes sense to just keep it there for now. Why don't we look at some questions, Sang? Do you have anything that's bubbled up?
Yep, absolutely. We have literally 5 minutes, Paul, so we'll hopefully get in like 2 questions, and hopefully you could get very short, concise, correct answers. So the first question, and this is actually something that I've gotten through our client base as well after reading the report. How will cloud change the technology spend? Will the spend go high or low?
Yeah, it's already. It's part of what, it's part of the hardware compression that's going on, and there's some fascinating insights in the individual modeling. Cloud has, in fact, I wrote a piece on the blog several months ago called Crowding Out, and the thesis was that the need to develop proprietary software to respond to regulatory pervasiveness, there's no third-party solution that you can buy off the shelf to solve the software needs and the reporting needs of a large diversified financial intermediary like the global, like the largest banks, the so-called GSIBs. And that need for budget to be moved towards software development has actually caused a tipping point in the adoption of cloud and other infrastructure as a service solutions. So it will drive the spend down. That it's part of our estimation and prediction that software will be the biggest part of the components over the course of the next couple of years.
Great. Thank you. Another question, again, we're quickly running out of time, so how much transparency consistency are there in data sets from the 58 banks? Maybe like literally a 1-minute answer.
There's consistency on the highest level stuff. There's consistency on revenue and headcount. Although with banks you have a lot of restatements, so there's probably room for me to write a report that gets into the nitty-gritty of how we decide which numbers to use. The other key point I want to make is one I alluded to earlier, and it's why we grade the individual models, because there aren't standards on transparency either between the different individual banks and within themselves over time because of M&A activities, because of restructurings in the taxonomy, how they present data. So what we lean on is context. And the context is, well, these 20 like banks spend so much of their operating budget on technology, and that at least helps us figure out where the spend might be in a model that doesn't have transparency. So we're using a bank today to help build the model of that same bank yesterday, sort of the absolute relative, and then there's the relative relative. Anybody who's a quant out there will understand absolute relative and relative relative. So I'm happy to explain all of that more later, but that's actually the precise answer.
All right, so I think we have time for one more real quick. How have you seen spend on IT in banks change between internal and external spend?
Yeah, so this gets to, I think, in part, my fascination with wanting to model the IT services sector, because what we see is the need for a lot of cost cutting, a lot of budgetary pressure. And in turn, one of the big conclusions that's going to come out of that study is that financial services broadly across banking, financial services, asset management, and insurance is the largest component of revenue for the IT services sector, whether they be the Indian sector or the non-Indian. You know, kind of break it down between the India domicile versus the non. So that is a key theme. The outsourcing is still the key theme. I think what is going to be fascinating to talk about and write about in that study is the fact that when you outsource, you're essentially giving away the ability to innovate for that workflow. So you may be engaging in the labor arbitrage, which is really the main reason still. I know we don't have the time to get down into that. The question is, beware the low bidder. So you're saving a boatload of money, but the opportunity cost of outsourcing tasks and entire workflows means that you're giving up the ability to innovate in terms of process innovation. And I think that that's something that's going to become more relevant, that folks are going to wake up to the fact that, hey, wait a minute, I can't innovate around that piece of my service offering anymore. And I'll leave it there, and I'll look forward to tons of questions afterwards.
Excellent. Yep, thank you. And my apologies, we obviously have a lot more questions to get to, but we've run out of time. But for those of you who submitted the questions, we'll definitely get back to you, do our best to get back to you afterwards individually. Lori?
Great. Thank you, Sang, and thank you, Paul, very much for presenting today. And I want to thank all of our attendees for joining today's webinar. We hope you found today's session informative. As a reminder, a recording of today's webinar will be available on demand for all attendees. Look for an email from Aite Group Webinars, which will be sent out within 24 to 48 hours after the conclusion of today's webinar. And that will contain more details on how you can view today's webinar. Again, if you have any questions, or as Sang mentioned, if we were unable to answer your questions during today's webinar, we'll do our best to get back to you at the conclusion of today's webinar. If you would like any additional information about any of today's content, please email us at info@aitegroup.com. Again, thank you for joining us, and we hope you have a great rest of your day.